The Canadian government is bankrupt. They just don't know it yet. Here's the reality. If interest rates go up to 5%, the government will be unable to make even the interest payments on the outstanding debt. Never mind the principal. In this video, I'm going to explain what you should do to continue to grow your wealth over the coming months and years, and why now might actually be a great time to take on some long-term debt. Let's begin. In March of 2021, Canada's total government debt was $2.852 trillion. That's over $76,000 per capita for federal, provincial, and local governments combined. In Canada, GDP, gross domestic product, in 2021 should be about $1.67 trillion. That means that debt to GDP in Canada is close to 200%. Let that sink in. We would have to take every dollar that was spent by anyone in Canada, by individuals, companies, and even from the government for 2 full years to pay off the national debt. Government spending in 2020 was $650 billion and the deficit was $354 billion. That means that more than half of the budget, more than half of government spending was deficit spending, spending money that they didn't get from taxes or revenue. It was literally money that was printed. It came from borrowing. There are 2 possible outcomes from this situation, and I'll explain both of them in this video and what they mean for you and your wealth. But first, we need to understand what bankruptcy is. For an individual or for a business or for a government, it means essentially the same thing, that you're no longer able to pay your creditors and that you must default on your debt. Guys, in 2020, 7% of Canada's government spending went simply to pay down the interest on government bonds. For example, it's like if you're paying the minimum interest-only payment on your credit card bill. You're not actually reducing your credit card bill, you're just not making it grow at an even faster rate. 7% might not sound like a lot, but that is 7% of the budget, with the interest rate on the debt at historically low levels. Interest rates are at 0.25% to be exact. So can't the government just keep the interest rate at this low level and slowly pay it off over time? Well, if the government wants people to be able to afford groceries, then probably not. Inflation hit a 30-year high this year of nearly 5% in Canada. Here's the thing. To cool off that 5% inflation 30 years ago, what did the Bank of Canada have to raise interest rates to? Was it 2%? 3%? Remember, right now it's 0.25%. Actually, in 1991, when the inflation rate was about 5%, the interest rate on Canadian government debt was 12%. If the Bank of Canada raised interest rates to 12% today, that would mean 100% of the Canadian government revenue would have to go directly to paying the interest on the federal debt. That's right, that would leave nothing for national defense, transfer payments, employment insurance, healthcare, elderly benefits, or children's benefits. Literally zero. If rates went to 1990 levels of 14%, the Canadian government would immediately have to default on their debt. They wouldn't even be able to repay the interest with 100% certainty. But why would the Bank of Canada do that to the Canadian government? Well, the answer is that the Bank of Canada's mandate for the last 5 years and for most of its history has been to keep the inflation rate between 1% and 3% per year. Since inflation is well over this target, the Bank of Canada must act to try to lower inflation. The only real tool that the Bank of Canada has to lower inflation or make prices go up at a slower rate is to raise interest rates. By raising interest rates, debt becomes more expensive. So businesses, individuals, and governments have less access to money, and so, theoretically, they'll spend less. The problem is, most of the debt that is being taken out right now is not for consumer spending, it's for buying assets like real estate and even stocks. Real estate makes up nearly 25% of the Canadian economy, and that means tax revenue. So if the cost of debt increased for people buying real estate, this would likely cause a slowdown in buying and a drop in real estate prices and a corresponding drop in Canadian GDP and government revenue. Are you starting to see the problem here? Raising interest rates will create a double whammy on the Canadian government. Not only will it increase their costs by increasing the amount they have to pay in interest on the debt, it will also reduce government revenue by slowing spending in one of the biggest areas of revenue for the government. So the government will have more interest owing and less revenue to repay it with. That is very bad. So what could happen here? I mentioned before that there are two options. Well, option one is that the Bank of Canada raises interest rates 8 times before the end of 2023, as Scotiabank predicts. Housing prices inevitably crash, and the Canadian government has to contemplate defaulting on their debt. Or, after about 2 interest rate hikes in 2022 to around 0.75%, the housing market starts to fall and the stock market begins to soften. Jobless numbers start to tick up and people start struggling to pay their mortgages. And the interest repayment on federal debt is starting to become a bigger and bigger share of the Canadian government's budget. Even though the inflation rate is still at 6%, the Bank of Canada U-turns on the interest rate and drops the interest rate back to 0.25% in order to boost the economy and allow the government to keep spending money. Which option do you think is more likely? Will Canada default on their debt? Will the central bank simply forgive the debt that the government owns? Canada is admittedly not in as bad of shape as countries like Japan are right now, but it's pretty close. Japan's debt to GDP in 2020 was 254.1%, while Canada's is a measly 117.5%. But that's the federal gross debt. The provincial and city governments brings that number closer to 200% in my opinion. It's clear to me that if the government and Canadians want to keep spending money on environmental initiatives and on social programs, or really on anything, it is very unlikely that they can raise interest rates very far. Unfortunately, if this is the case, that means that prices will likely keep rising as more and more debt-fueled spending continues to flood into the economy. This is bad for the poorest of us because wages will not rise at the same rate as prices, and it will continue to be harder and harder to afford a home. So I said at the start of this video that I'd explain what you should do to keep growing your wealth. The answer is really simple. In inflationary times, the best way to stay ahead is to buy appreciating assets and get as much long-term debt as possible. That's right, you heard me right. Get as much long-term debt as possible. If interest rates stay low, like I think they will, home prices will keep rising. That means if you want to grow your wealth, owning real estate is probably a good idea. If you can get a low interest rate loan, then as inflation takes off, you can take advantage of leverage to grow your wealth. Look, I'm putting my money where my mouth is because I just bought a house. Here's how I think this will play out. If I buy a house today for $1 million and put 20% down, and housing prices go up 10% in 2022, which is 1/3 of what they went up in 2021, then my house will be worth $1.1 million next year. Great, I just made a 10% return, right? That's like half of what the S&P 500 has been doing. Wrong. I actually just made a 50% return on investment in 1 year because while the house price went up by only 10%, I only invested $200,000 and now I have $300,000 of equity in the home, my $200,000 down payment plus $100,000 in appreciation. Isn't that crazy? As long as the government is stuck between a rock and a hard place, defaulting on their debt or actually lowering spending, it's likely that this trend will continue until interest rates are permanently stuck at 0%. How long will this last? I have no idea. But until we see countries like Japan having their central banks forgive their country's national debt, I think it is likely that the Canadian central bank will continue on the same course that it has in the past, pumping up asset prices and eroding the purchasing power of the poor and middle class so that they can continue spending. Do I think this is a good thing? Absolutely not. Do I think they are doing the right thing? 100% no. Do I think they'll keep doing this anyway? Of course they will. Look, I'm not telling you what I think is right or good, only what I think will happen. But let me know what you guys think down in the comments below. Is there some other way out of this that I'm not seeing, or are you going to be joining me and investing in real estate to ride out the inflation? Or will you just keep hodling crypto like a smart person? I'm interested to hear your thoughts. Make sure you take a look at some of my sources in the description down below, and be sure to do your own research. I'm not an investment advisor. But for now, that's all. We'll talk to you in the next one. Peace.